if you go into Blackboard to our class, I don't know what y'all see, but anyway, on the class and the content under the exam guides and reviews, I just added a new file. It's practice exam Excel allowed 1 and 2. So you can see exactly what I'm going to give you on the exam. So I'm just going to start. If you need something, you got to interrupt me. You probably better interrupt me speaking, because it's hard for me to do chat while I'm doing stuff. Any questions before we start? Everybody's good? Okay, so the first 2 problems, I'll let some of the class be on Excel when the other class is working other problems, and then we'll switch, because I got to make sure all you're going to get is the Excel file I'll give you. You can't open up the Excel file you did for the homework. So I'll show you what we have. So you'll all be able to use Excel, but not all at the same time. So I can just monitor. You're honor students, but still I don't want any temptations. So this is what I'll actually show you. Can y'all see the question there? I mean, you'll have it on the printout as well, but you'll have the question here. Can y'all see that? Emily, can you see that?
Yes, we can see it.
Okay. So I'll give you this and you got to do the rest. All right. So you see, you got the 2 formulas there. So here we have this guy named Fachi. I don't know where I got that name. I just made it up, I guess. He wants to start a medical practice in 10 years. Expected the cost $400,000. So I might put in here the target is 400,000. You don't have to do that, but that's the way I did it. Just I want all the numbers typed out that I need. He will invest monthly for 10 years. So what should my time be? Anyone want to give me that?
120.
120, exactly. So our 10 years times months. So if it was weekly, you 52. If it's weekly, I'll tell you it's 52 weeks in a year, but 120. And then what's your interest rate? He said 576. Anybody want to give me that? Okay, so 5.76.
0.48%.
So divided by 12, you got to be real careful, because if you type that, is that the right answer? That's 48%.
No.
You got to do either 5.76% divided by 12, or you got to do 0.0576 divided by 12. All right. You know, a monthly interest rate is not going to be 48%. So just be careful on that. That's probably the biggest issue people would make. And then you know the titles. First title is time. Second title is beginning balance. Third is, well, you can switch these 2, but I'll say interest, and then payment or investment, and then ending balance. So in this case, is this a present value problem or a future value problem? So you can tell if he's borrowing money, it's going to be a present value problem. He's not borrowing money, he's saving money. So here it's going to be a future value problem. So it's going to be interest earned. And instead of a payment, it's going to be an investment. But if you saw borrowed money and you have practice problems from the Excel applications, you'd have that. All right, so time is going to be the same as whatever's in your time up there. So you go down 120 or so. You want 120 months. Your beginning balance, if you're saving, your beginning balance is 0. If it's borrowed money, your beginning balance is however much you borrowed. Your interest is always going to be whether it's interest earned or interest expense, it's going to be beginning balance times your interest rate. You got to make sure you lock that in. If you're on a Mac, I think it's Command and F4, but or else make sure you put those dollar signs in there. The investment's going to be your target divided by your future value interest factor, or that amount. And your ending balance, if it's a savings, a future value problem, you just sum across. If it's an investment, if it's a borrowing where you have debt, it's beginning balance plus the interest expense minus your payment. Then you have to set up the second year, the second month. So the second month, your beginning balance is your ending balance from the previous. Your interest earned, you can copy that down. Just make sure I do prefer you put these things in 2 decimal places. Some of y'all turn your homework in like this. I don't know why you do that, but don't do that. Make sure your columns are wide enough. Your investment just repeats in your ending balance, and then you can just copy that down, and you'll know if you did it right if the last number is $400,000, and it is. All right, so there's your first problem. If you were borrowing $400,000 a day, then you would have started with $400,000. Your interest expense, let's say he is building his business today, he borrowed $400,000. His interest expense is that, and then his payment will be that. And then here you're going to do, sorry. Yeah, if y'all are on the chat, okay, sorry. Yeah, y'all are answering my questions, sorry. So make sure anyone else going forward on the chat, make sure someone's monitoring it. If I need to stop, let me know. So here, your ending balance is not going to be a sum. It's instead going to be your beginning balance plus your interest expense minus your payment. So here it becomes a payment. Just copy that down, and you should have 0 at the end, all right? So that's the key. Now, you don't get 0 if it's a present value problem. You do it as a future value. You'll get some credit, but you will lose quite a bit. But you can just tell if you're borrowing money from a bank, it's going to be a present value problem. That's just the nature of that. If you're saving for the future, that's a future value problem, all right? Any questions on that first one? So you see what I give you. I give you that, but with the wrong numbers in B1 and 2. I'll give you the problem in the Excel so you don't have to go back and forth. All right, so you just have, I really want you to be able to do this off the top of your head. I think that's incredibly important that you have that kind of Excel skill that you can do an amortization schedule or an investment schedule. All right. Now I'm going to get rid of all of that I just did, because I want it to equal 400,000. So that when I save it, it's the right answer. Okay, question 2. So question 2, I don't know who Whitmer was. I can't remember that, but so here's all the information. So what I give you here is I give you the cash flows typed out already. If I were you, I would type the rate. Your rate here is 5%. And then it's the same kind of thing. You're going to have time. So your time is going to be equal today. And then you're going to use the mid-year convention. So that plus 365.25 divided by 2, or however you do it, plus 183. It doesn't have to be exactly the same. I like using the 365 divided 0.25 divided by 2 just because then you can just add 365.25 all the way down. So there's your 3 years. Anything approximating that is fine. If you're within a day, I'm fine. I'm not picky on that. All right, so then you're going to do your net present value, your IRR, and your discounted payback. And then Bill Gates does all the work for you. So you just do X NPV. You do the rate, comma the values, comma the dates. So you might say, why am I testing you on this if Bill Gates is doing all the work? Well, I want you to know that the X NPV exists and that he's doing all the work for you. So there's the answer there. Hopefully y'all were getting this same answer. The IRR, same thing, X IRR. Do the values, do the dates. They don't really need a guess anymore. So you get 12.36%. And then a discounted payback's the most difficult one. So here, you've got to do the cumulative DCF, or net present value. So you know you start off at negative 750. So then you do X NPV. You do the rate, lock that in, comma the values, comma the dates. And then remember, you've got to lock in the first date so that you can copy it down. And when you copy it down, you know you did it right if the last number matches your net present value. And don't turn in your exam with like this. Irritates me when I see that. You always want to turn in stuff, you turn in always look professional, so don't go so fast. And then your each year, I forget what I called it, net present value. So there you just take the current minus the previous. Copy that down. That should, the sum of that should equal your net present value, and it does. So there you got it. And so then you got payback calc. This is the part a lot of students may just not get this one, but do your best. You can just do it manually. So you know if the cumulatives, you don't start with the first year because that's zero. So you don't need you don't need times zero, that's zero. If it's negative, you need all of the year. If it's negative, you need all the year. And so here, you started with 207 in a year where you had 287. So you take the negative 207, divide by the current year, and you get 272. So if you want to, you can do that. And then your payback, it's just the sum of those. So you see how you don't have to have that fancy equation if you don't want to. If you want the fancy equation, you just say if cumulative is still less than zero, then I need the whole year. If it's not, but the previous year is greater than zero, then it's zero. Otherwise, take minus the previous year divided by the current year's change. Oh, I need a parentheses there. Yes, sorry. I need an if there. This is the reason why you might not do that one, but so if that's less than zero, give me one. Otherwise, if the previous, give me zero. Yeah, shouldn't do this while I'm talking. Then if that one is, then give me zero. Otherwise, give me that. That looks correct now. So if C18 is less than zero, give me one. Otherwise, do this. I'll probably have one too many parentheses here. If C17 is greater than zero, then give me zero. Otherwise, give me that. Here we go. So it takes me a little bit. But on the exam, you don't need that. If you want to show off on the exam, then do that. That's fine. But you're going to be time constrained. Y'all can see how this one's a lot easier. You just look at the cumulative. Once it turns positive, you take the deficit from that previous year, divide it by the each year's NPV. You got to make sure you got the right column. I've seen a few of your CBA teams where you mix the two columns. So whenever it goes negative to positive, you take that last negative and then divide it by the current year's. So you're going to do minus a previous line divided by a positive current line, and that will give you 272. And then you accept. NPV is greater than zero. I do want you to put all this in here. Here you accept. IR is greater than the cost of capital. Here, what was their 2.5? Here, reject. Payback is greater than the standard, something like that. All right. Any questions on this one? So those are the things to do in Excel.
Can you do the formula for the cumulative MPV again?
Yeah, it's the same formula we use down here, except for you only do the 2 lines. And it's the same formula if you only do 3 lines. So you're doing the exact same formula again. But you just do it. So the last one's the exact same formula we use here. All right, is that good?
Okay, I got it. I was missing dollar signs.
All right, so there's question 2. You can just submit the Excel on Blackboard. So, you'll probably have about 25, 30 minutes. We'll see as we get into it. All right, so there's question 2. For questions 3, 4, and 5, we're just going to do each one individually. So the first one says determine the beta. So for the beta, we have 4 steps. This is all off the top of your head. Nothing's provided. Step 1, we decide what kind of company is this. I call it revenue sensitivity. We're looking at a firm called BWA. I'm going to say this is definitely a cyclical company providing parts for cars, a durable good, and very sensitive to the economy. Now, if you didn't know that, then do your best. I give you a description of the company. If you go up and look, I tell you who it is somewhere in here. Boy, where is it? Oh, they manufacture and sell components for cars to auto manufacturers. If you didn't know for sure that was a high beta company, then you might look at the history first to kind of get a sense of what you're dealing with. You can see it's well above 1. But yeah, this is definitely. So put this in your answer. So beta well above 1. All right. Number 2 is operating leverage. So here what we're going to say is look at their net margin. It actually ranks pretty well. They rank the 30%. I would say, I would assume, again, this is, you have to just be logical. If you don't agree with me on the type of company, they have high fixed costs given they are a manufacturing firm with high property, plant, and equipment and unionized workforce. However, their volatility of net margin is lower than the average stock in the market. I will assume higher operating leverage even with these stable margins. So beta well above 1. But whatever you say is fine as long as it's logical. You only get in trouble if you're inconsistent. So you don't have to agree with me. I might strongly disagree with your answer, but as long as you're logical, you're fine. The next one is financial leverage, which is the easiest one of all. So that one, you just go up, excuse my typo, there's typing, there's probably gonna be typos in this thing. Here we go up to the debt. Their debt to equity at 50%. Their debt to equity is slightly below the average stock in the market, suggesting we can bring beta down a little, but still well above 1. Some of you in your financial apps were much less wordy than this. I suggest you be a little more wordy, add extra words. And then the last one is history. So history seems to suggest a beta between, say, 125. You guys, this unusual period here in the financial crisis, but suggests a beta between 1.5 and 2 is what I'm going to say. Which is in line with the 1, 3 above. Therefore, I will use a beta of 1.75 or 1.5, whatever you want to use. I'm going to look and see what I use on my answer key, but whatever you use will work. So I'll use 1.75, but you'll have to decide what you use. So there's my answer. If you want to, you can separate this last one out from the rest and say I'm going to use a beta 1.75. Any questions on that? You have done that on your financial app, so it looks just like that. Okay, I'm going to keep going. Calculate the weighted average cost of capital is really important on these type of questions that you write the formula first. So WACC equals the weight of debt times the cost of debt times 1 minus the tax rate. You can use abbreviations like that, plus weight of equity times the cost of equity, cost of debt equals the risk-free rate plus the spread, cost of equity equals risk-free rate plus beta times the market risk premium. So let's see what we have up above here. We've already got our beta, so we'll put that in there. So our beta, I'm going to use, oops. Sorry. I don't want to hit the escape key because of Zoom, so it really messes things up for me. So I've got my beta 1.75. So let's go fill in the other pieces. Equity risk premium 6.4. Wow, I don't know why I'm using that. That's a pretty high equity risk premium, 6.4. Equity risk premium, market risk premium are the same. Let's see what else we have. Their debt is 20-year bond issued 18 years ago. So it's a 2-year bond with a coupon of 7 maturing in 2 years. Ready BBB plus. So 2 years and BBB plus. So 2 years. Where's the treasury rates? It's gonna be a lot easier for you because you will have it right in front of you. So 2-year treasury is 0.6%. Make sure you type percents as decimals. So 0.6% is 0.006. 0.06 is 6%. So 0.6%. So just divide by 100. 0.6% divide by 100, you get 0.006. And our spread, the BBB plus for 2 years, 2 years BBB plus, that's 85. So that's plus 85 divided by 10,000. That's going to equal 0.0145. So we've got their cost of debt. I'll see how I'm converting everything into decimals. All right, what else do we have? They had 1.5 billion in debt and 4.5 in equity. So the weighted debt is going to equal 1.5 divided by 1.5 plus 4.5. And the weight of equity is equal to 1 minus the weight of debt. So that equals 25%. And that equals 75%. So we can put our weights in there. 0.25. Again, convert it to decimals, 7.5. What else do we have here? The marginal tax rate is 21%. So 1 minus 0.21. So we got everything but the KE. Let's get the KE. The KE, the risk-free rate is always for stocks. We're going to use the 10-year treasury. So the 10-year treasury is 0.9%. That's why my market risk premium is so high. 0.9%. So that gives me a KE. If I did it right, y'all can double check my numbers. I get someone double check me, make sure. If you didn't use 1.75, you'll have to double check. Let me know if you know before we hang up this call. Tell me before we hang up. Don't email me afterwards and say you had a typo, because then everybody's going to have the wrong answer. I think it's correct because I'm using it in I've got it set up in Excel. So if someone can confirm that, let me know. So that gives me my cost of equity, and that gives me a WACC of 0.0936, 9.36%. I'm going to double check just to make sure. So 0.25 times 0.89 times 0.0145 plus 0.75 times 0.121, 936, that looks good. 0.009 plus 1.75 times 0.064. It's 12.1. I think it's correct. No one's saying they got this number, but I think it's correct. But there's your answer there. There's our answer there. And again, this is just plugging numbers into a calculator. You don't even need the exponent key yet. All right. Y'all interrupt if y'all have questions. The next one is the value of a bond with the face of $1,000. So our KD is 0.0145. The effective yield is 1 plus 0.0145 divided by 2 squared minus 1. And that's going to equal, let me go out a decimal place here, 0.015455. And then you set it up. We can do it as a table. Let's put 4 columns and 5 rows. So we got time, we got the cash flow, we got the discount factor, we got a discounted cash flow. So time, we know bonds pay every 6 months. We know this is a 2-year bond. So here's our time, our cash flow. If a 20-year bond issued 18 years ago, that's when it's 2 years, it's 7%. So 7%, remember your cash flow. Your cash flow is going to equal the face times the coupon divided by 2, which equals $1,000 times 0.07 divided by 2 equals 35. we got 35, 35, 35, and then at the very end, get your $1,000 back plus the 35. Your discount factor is going to be 1 divided by 1 plus the effective yield raised to the time, which equals 1 divided by 1 plus 0.01455 raised to the 0.5. That equals 0.9928, 0.9857, 0.9786, 0.9715. You do it to the 0.5, you do it to the 1. I'm not going to type them down each time unless y'all want me to do that. Hopefully, you know, each time you do whatever's over there on the side. And that should give you cash flows of 34.75, 34.50. You can have some rounding issues. I don't count off for rounding, so don't worry about that. And so the value of the bond equals the sum of the discounted cash flows, which should equal 109.02 or something in that ballpark. Here it looks like it rounds correctly because it comes out to 2 cents. So, right? Remember on the exam, you have to show this table. I'm requiring this table. So make sure you have this table. You don't have to do this. Just put the factors in, that's fine. You know you did something wrong if you don't get 0.9 something. I'm not going to give you interest rate that's so high you're going to get 0.6 or 0.7. And you definitely won't get anything above 1. So your discounted cash flow is just your $35 times your 0.9928. You just multiply across, all the way across. All right, any questions on that? Now your calculators will do this as well. If you figured out your calculator, I also gave you the long formula. That's fine. Giving me the right answer doesn't give you any points. You have to do the table. But if you figure out your calculator, you can check that you got the right answer using your calculator, which I don't have any problem with you doing that. So that's perfectly fine. All right, any questions on that? I think everybody's got it. Y'all are really quiet, so it means we got a bunch of hundreds coming on this exam, which is great. All right, the next one is the valuation. So cap earnings formula is EPS 0 times 1 plus inflation. And again, write the formulas down. Divided by KE minus inflation. Dividend discount model is dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. And then the H model is the dividend discount model. One little section. I always do it like this because I want to prove to you you're not really learning anything that much more. Plus dividend 0 times H times short-term growth minus long-term growth. So again, it's just a matter of plugging numbers in. Earnings per share and inflation, we can get that. Earnings per share 145,361. 145,361. And our long-term growth is 4%. What else do we have here? So our dividends was $1.45, earnings per share 361. Our long-term growth is 4%. Inflation's 2.5%. our KE was whatever it was, 1210. And that should give you a value of 38.54. I'm going to double check everything because I'm a little nervous. 3.661 times 1.025 divided by 0.121 minus 0.025. Sure enough, 38.54. And so here we have 145 times 1 plus 0.04 divided by 0.121 minus 0.04. And that should equal 1862. Let me double check that. $18.62, that one works. And so here we have 1.45 times 1 plus 0.04 plus 1.45 times, let's get our H and our short-term growth and we're done. So earnings growth would be negative 5%. There's our short-term growth. Over the next 5 years, H is one of that. So negative 5 and 2.5 are our numbers. If it's negative, you just type it as a negative 0.05, negative 0.05 minus 0.04 divided by 0.121 minus 0.04. And that was going to give you a number that's smaller than your dividend discount model because our short-term growth is a negative number. It gives us 1459. Let me double check that one. And that gives you 1459. So that's the correct answer. If you want to check, you can. And that should just be this little section here. So if we do that, 1.45 times 2.5 times minus 0.05 minus 0.04 and divide all of that by 0.121 minus 0.04. We get minus 4.03. 18.62 minus 4.03. Does that equal? And it does 14.59. You don't have to do the check, but you know, why not? This is a question when you have more time than you really need. It's pretty easy to plug these numbers in. And so if you just want to double check, you certainly can. But there's your answers there. Any questions on that? I like this question because it makes you take what you already know and just go search for the inputs. And you have to have some sense of what the inputs are and what you're putting together. But here's your evaluation. All right, we're moving well here. It's only been 39 minutes. We're almost done with the exams. So I'm not hearing any questions. So again, it sounds like we're going to have 100% on the exam. All right. All right, I hope y'all are still there. All right, I'm seeing people there. Y'all aren't. Okay, good. All right, so economic value added. This one, pretty simple math. You just got to remember. So you've got your accounting profit is 600,000. Economic profit is going to equal the accounting profit. For our purposes, we're going to add back depreciation. We're going to add back interest expense. We add back depreciation because it's not considered an economic expense. It's just a random allocation over time. We're adding back interest expense because our economic profit doesn't include anything that's cost of capital. So that should give us an economic profit of, well, if we just do it, we get 600,000 plus 80,000 depreciation plus 400,000. And it gives us an economic profit of 1,080,000. Then we need our cost of capital. That's going to be cost of debt. We already have that one. That's the 600,000. How do we get that? Well, she borrowed 5 million at 8%. Whoops. Oh, my interest expense is 400,000. Hopefully y'all caught that. Times 8%. But you have it. You don't have to calculate it, but if you want to just double check. See, in that case, double checking actually saved me because I accidentally typed the accounting profit instead of the interest expense. And then the cost of equity, you do have to calculate this one. So here she invests 4 million of her own money, and she requires, boy, I have a typo in there. She requires a 14.57% return times 0.475. If you do that math, you should get 590. Hopefully someone's getting that. And so total cost of capital is going to be 990,000. Hopefully you are getting that. So your EVA is just going to equal your 1080 minus your 990. That equals $90,000. And your EVA spread equals the 90,000, your 4 million plus your 5 million, sorry. And that does equal 1%. Yeah, so you divide your EVA spread by your total amount of capital employed. That gives you 1% EVA spread. Sorry about that. Y'all be teaching classes one of these days. You can see the brain does strange things when you're talking to a group. All right, so there's your EVA. Any questions on that one? Most students don't have too much trouble on that one. You notice we ignored the salary she paid to herself. That really doesn't have anything to do with this problem. Questions on that? We get to the really easy problem. So we have a hedge fund has determined that its portfolio's daily expected return is 0 with the 1.2 standard deviations. We know that the value at risk equals the mean minus, again, write the formulas down, the number of standard deviations times the standard deviation, which equals 0 minus the number of standard deviations times, here our standard deviation is 1.2. Again, convert it to decimals. The risk tolerance is 1%. So table value equals 1 minus 0.01 equals 0.99. You already know what that is because that's a pretty common number. So 0.99 is right here. at 2.33. So we calculate the 2.33 there. And remember, we do VAR in absolute. So ignore the negative numbers. And that gives us a VAR of 2.8%. Their budget is 25 million. So we need to convert our VAR into millions. So VAR in dollars is going to equal 0.028 times our portfolio. Our portfolio is $1 billion. So that equals 28 million. You make it slightly, I mean, if you, depends on how far out you round, but rounding 2 places, the 280 is fine. It does go out more decimals than that. So if you go out in more decimal places, you might get 2796, but 28 million is fine. And then don't forget this last part. You need to say they exceed, or you can say the VAR exceeds the budget, so they are out of compliance and taking on too much risk. Questions on that one? And essentially, that's the exam right there. We did it in about 50 minutes, other than the last essay question. I'm not going to give you the last essay question. It's in the notes, but we can label the lines. You know, on the lines, that cost of debt has to be the lowest line. Cost of equity is the highest line, and WACC is the middle line. If I give it to you this way, if the lines are going up, and you have to look at that chart. So that's in the notes. There's 2 ways to do this. You always know that the y-axis or the x-axis, the x-axis is always the percentage in debt. You start with no debt on the left and 100% debt on the right. You know that the maximum value of the firm is wherever WACC is its lowest. We know that KE goes up because you're taking in more debt. We know that the WACC falls only because of the tax shield of debt, but then the WACC starts rising because of the cost of bankruptcy. If the lines are going down, then the y-axis is your cost of capital. If the lines are going up and they come to max and come back down, then your y-axis is the value of the firm. So you need to explain all those things, but I'm not going to give that to you again. We've talked about that. That's in the class notes. So I'll just be reading the class notes to you. So on the essay, there's one question. You got to do some critical thinking and figure it out on your own. But the math problems is the main thing I want to focus in on. I'll put this answer. Did anybody find any typos in what I'm doing? Did y'all get these answers? I mean, obviously on the stock valuation and the WACC, you got different answers if you didn't use my 175.
So are we going to be typing this in Word, or are we going to be writing all this out?
Be writing it out on paper. But you have plenty of time, so don't worry about the time. So someone asked you, you're asking about how to get the investment again. Which question was that? That was early on. We got that one, didn't we?
Yeah, I got it.
Okay. I know I spoiled you all on the first exam, but you have to do some writing. I actually want to see you write this stuff out. The essay question is not that much writing, but make sure you cover all the points. The complication there is I gave you like 3 different versions of it, so you have to look through and make sure you've covered everything. So don't give me a short answer. Give me a full answer on that last one. I don't see any reason why you wouldn't get 100%. on the math problems. And yeah, Isaac, I'll put this on YouTube right after the night, and I'll put the Word document that I just typed in and the Excel back on Blackboard as well under exam reviews. Everybody understand how it's going to work? Sorry that the exam's on Thursday. It's usually not that early, but might as well get it out of the way. Well, on the beta, it's a cyclical company with a little extra debt. And the history showed they were between 1.5 and 2. You'll just have to look at the historical graph. The last several years, it's been consistent between 1.5 and 1.2, but you might disagree with that. You have to, as long as you're consistent, it's fine. And Anthony, you can use any calculator, but show all your work. I don't care if y'all can use calculators. I want to know that you know the math. So I'm far more interested. So write out every single formula. Don't just give me the answers. Write out the formula, especially on things like the debt. Make sure you write out the entire table. But even on the equity, if you write all the numbers down and you just have a math error, you'll get 100% credit. If you don't write it down, you just give me the answer and you're off a few pennies, I can't give you any credit because I don't know that you have the right answer. So write everything out in detail. That probably help you as well to make sure you didn't miss something. And then I can give you partial credit. I can't give partial credit if you don't show me how you got your answer.